In the previous module, we discussed the historical performance of Hero MotoCorp. In this module, that is valuation, we'll establish the value of Hero MotoCorp by analyzing its historical performance and making projections of its future financial performance. What is valuation? Market value. You can Google Hero MotoCorp share price. You will be shown a value. Every day, even during the day itself, this value changes. This value is known as market value or market price, that is the price of one share of Hero MotoCorp. This is the value market as a whole is deciding for Hero MotoCorp. When you multiply this per share price with total number of shares of Hero MotoCorp, you will get the market value of the whole company, also called enterprise. Fair value or intrinsic value. You can calculate your own price for Hero MotoCorp based on company's financial performance. That value is known as the fair value or intrinsic value. Please remember that market may be euphoric or pessimistic, and that may lead to differences in market value and your calculated intrinsic value. And there may be opportunity because of the difference between fair value and market value. This is something that we will be discussing a little later in this module. Valuation is the process of arriving at the worth of the company, also known as intrinsic value or fair value, and this is done by analyzing its financial performance as stated in its financial statements. Why do we need valuation? There can be a variety of reasons why you would want to know the value of a company. For example, investing. Say you want to purchase the share of a company and you want to know what price you should pay for it and whether the price you're paying is reasonable or not. Mergers and acquisition. When one company buys another company, both of them would want to know the price at which they would want to buy or sell. Divestitures. When one company decides to sell part of its business. Each such event requires an opinion on understanding the value of a company. What drives valuation? Well, there are three core pillars that drive the valuation of a company: profit, growth, and cost of capital. Let's understand these one by one. Profit. Let's say there are two companies, A and B, each of which make a profit of say rupees 10,000 and rupees 20,000. Everything else being the same, as you can imagine, company B would be more valuable than company A as it makes more profit. Growth. Only profits are not important. At what rate they are growing is also important, since current value of a company depends on future profit it is expected to make. Let's take the same example and let's say that both the companies A and B make a profit of rupees 10,000 each. However, company A's profit are expected to grow at 20% every year and company B's profit are expected to grow at 10%. Which one do you think is more valuable? Yes, company A is going to have a higher valuation since it is expected to make more money in the future. Cost of capital. Well, this is a new concept for you, and before we understand how cost of capital impacts valuation, let's first understand what cost of capital is as a concept. Every business needs some capital or investment to commence its operations and to run its day-to-day operations before it turns profitable or receives money from its customers. For example, when Hero MotoCorp started, it must have invested some money to set up the factory, hire the workers, procure raw material, etc. before it could begin manufacturing two-wheelers and sell them in the market. This money is called the capital, and it may have been given by shareholders or promoters of the company which is referred to as equity, or the company may have borrowed this from the bank, in which case it is referred as debt. Now this capital has some cost associated with it. For example, when you borrow money from the bank, you pay interest on it, say 10% per annum, and that 10% is referred to as cost of capital. Now let's say in our example, both company A and B started their operations by borrowing rupees 10,000 each from the bank, and each generated a profit of rupees 2,000, which is 20% return on capital. That is 2,000 divided by 10,000. However, company's A's cost of capital, that is the interest it pays to bank, is 10%, while company B has to pay 15% interest. Which one do you think is more valuable? Yes, company A, because its cost of capital is less, and hence the money it would be left with after paying interest expense is more. Another way to look at this is that for a company to create value, its return on capital should be more than its cost of capital. Else all the profit will be used up in servicing the capital. That is, paying the interest in case the capital is in the form of debt. Now you may be wondering, what if the capital was not in the form of debt, on which the company had to pay interest, but in the form of equity? Or what if it was partly your own money and partly borrowed from someone else? It may surprise you, but that also has a cost, and we will cover that in greater detail a little later in this module. For now, it is sufficient for you to know that everything else being the same, a company with lower cost of capital is more valuable than one with a higher cost of capital. Valuation types. Although there are many approaches to business valuation, but we will restrict our discussion to two prominent approaches: absolute value and relative value. Absolute value is basically the value of a company based on the company's historical and projected financial performance and use of assets, whereas relative value is determined as a company's value by comparing it with similar companies. As the name suggests, the outcome of an absolute valuation method is the absolute value, or a number, whereas relative value is a ratio that can be compared across similar companies. There are many ways to arrive at absolute value. However, discounted cash flow, DCF, is the most commonly used method. Under the DCF method, future earnings are discounted to the present, thereby establishing a present value for the stock. For example, in the case of Hero MotoCorp, application of absolute valuation will lead you to a share price that can be compared with the market price. If the company is trading at a market price lower than this calculation, it is considered to be undervalued. That is, market is not paying as much as it should. If the market price is higher than the absolute value, the company is overvalued. That is, market is paying more than it should. The relative value approach compares various valuation parameters of a given publicly traded stock, such as price to earning ratio, to the stocks of companies in the same industry. If this ratio of stock being evaluated is substantially lower than the peer group, the relative value approach views the company as undervalued, and if the ratio is higher than its peer group, the stock is considered to be overvalued. If you find terms such as DCF or price to earning ratio confusing, don't worry. We will study both these methods in greater detail in subsequent topics and apply them to arrive at the valuation of Hero MotoCorp. In this video, we will discuss one of the most popular ways of finding the absolute value of a company, that is DCF, also called discounted cash flow approach. In DCF valuation, the value of a company is the present value of the expected future cash flows discounted back at a rate that reflects the riskiness of these cash flows. The underlying principle of DCF valuation is that each company generates cash flow, and the value of a company is a function of the expected cash flows of that company. Companies with high cash flows should have higher values than companies with low cash flows. The formula to calculate a company's absolute value using DCF method is value of a company, free cash flow in first year divided by 1 plus R plus FCF2, which is free cash flow for second year, divided by 1 plus R raised to 2, and so on till free cash flow in nth year divided by 1 plus R raised to n. Here FCFN stands for free cash flow in year n. So if you're looking at free cash flow for the next 10 years, that n will be equal to 10. R stands for the discount rate at which these cash flows are discounted to arrive at present value. N is the number of years for which a company is expected to be operational. Does this formula ring a bell? Yes, we covered it in the second module of the training program, where we learned how to calculate the present value of future cash flows. The DCF valuation method is the application of the same method. If you look at the formula, we need three things to build the DCF model to calculate the present value of the company: the free cash flow, projection of what the free cash flow would be in year 2, 3, 4, and so on. That is projected free cash flow for the future, and the discount rate, that is R. For calculating free cash flows, we need to reorganize the financial statements of the company. To project future cash flows, we need to build forecast, and to arrive at discount rate, we need to calculate weighted average cost of capital for the company. Accordingly, the step-by-step method to arrive at DCF valuation of a company consists of the following 7 steps. First, reorganizing the company's financial statements. Second, building forecast. Third, estimating continuing value. Fourth, calculating weighted average cost of capital. Fifth, calculating the DCF value. Sixth, sensitivity analysis. And seventh, adjustments to DCF value to arrive at equity value. We would look at each of these steps one by one in subsequent videos. See you in next tutorial. As we mentioned in the previous video, to arrive at DCF valuation of a company, we need to perform following 7 steps: reorganizing the company's financial statement, building forecast, estimating continuing value, calculating weighted average cost of capital, calculating the DCF value, sensitivity analysis, and adjustments to DCF value to arrive at equity value. So let's look at these one by one. So the step 1 is reorganizing the financial statements. The free cash flow should measure the company's operating performance. Therefore, to calculate free cash flow, we must first recognize the reported financial statements into new statements that separate operating and non-operating items. We learned how to do this in the previous module. You may also remember that we calculated FCF from cash flow statement as cash flow from operations minus CAPEX or capital expenditure. While this is a good approximation for the purpose of valuation, we would calculate exact free cash flows. Further, the earlier approach does not help us forecast future cash flows. We reorganize our financial statements to come up with financial items that we can forecast. We prefer free cash flow over EBIT and net profit. EBIT includes the deduction of depreciation and amortization, which are non-cash charges. That is, you are not paying cash for these items, rather than these are only accounting entries. They have to be added back. EBIT also excludes items such as capital expenditure and changes in working capital, items that do impact cash flows and should be subtracted from EBIT. Similarly, net profit may contain non-operating items that may not happen in the future. Hence, using net profit may be misleading. Here is how you will calculate free cash flow. EBIT minus taxes, that will give net operating profit after taxes, NOPAT. Then you add depreciation and amortization, which is a non-cash charge. You deduct capital expenditure and also any addition in working capital. That will give you free cash flow. So EBIT stands for earning before interest and taxes. That indicates profit of a company adjusted for non-operating items. Taxes will indicate taxes that are paid to the government. Depreciation is added back because it is a non-cash charge, and practically this was not paid to anyone and hence did not impact the cash flow. As sales increases, you have to invest in plant, property and equipment. Since that investment requires a cash outlay and this investment is made to sustain or grow the company's operation, it is excluded from the free cash flow. Fifth, which is addition in working capital, is the money that the business needs to work. As the sales grow, you need to maintain a bigger inventory. The money customers owe you also increases, and hence more money gets locked up as part of working capital. Hence, when working capital increases, cash flow decreases. Since the change in the company's working capital is directly linked with its operations, any change in it should be recorded in the cash flows that we consider for building our DCF model. We will learn more about how working capital and change in it is calculated in the next video. In the previous video, we discussed the first step to build the DCF valuation, and in this video we will discuss how we calculate working capital. So working capital is calculated as accounts receivable plus inventory minus accounts payable on the balance sheet. Now you may recall that accounts receivable represents the money that customers owe to us. Accounts payable is the money that you owe to the suppliers. And inventory refers to the value of raw material under processing and finished goods. Now, if a company's accounts receivable increase at the end of the year, this means that the firm collected less money from its customers than it recorded in sales during the same year on its income statement. On the other hand, if accounts payable were to increase, it means a firm is able to pay its suppliers more slowly. The value of inventory going up means more money is locked up as raw material. Cash conversion cycle and forecasting change in working capital. Now you may be wondering, how can you forecast this change in working capital for future to arrive at future cash flows? For that, we need to learn the concept of cash conversion cycle. Simply put, CCC refers to how many days it takes for the company to convert inventory into cash. Let's learn this with the help of an example. Recall the coffee shop example we had taken up in the previous module, and say following are the numbers available from financial statements of your coffee shop at the end of year 1. Sales rupees 18,000, cost of goods sold or COGS rupees 12,000, AR rupees 4,000, AP rupees 2,000 and inventory rupees 3,000. So we want to arrive at cash conversion cycle for our coffee shop and use that to forecast change in the working capital in year 2. Now cash conversion cycle consists of 3 components: days sales outstanding, days payable outstanding, and days inventory outstanding. Let's understand these terms one by one. Days sales outstanding, that is DSO, simply put, means on an average, how many days does it take for you to collect the payments from your customer after a sale has been made. It is calculated as accounts receivable divided by sales multiplied by 365. In our example, we know that accounts receivable is 4,000 divided by sales, that is 18,000, multiplied by 365, that is 81.1 days. So our DSO given the example is 81.1 days. On the other hand, days payable outstanding, DPO, means on an average how many days credit do you get from your supplier. That is, within how many days do you have to make the payment to your suppliers after you have made a purchase from them. It is calculated as days payable outstanding, DPO, as accounts payable divided by cost of goods sold, COGS, multiplied by 365. Our accounts payable is 2000 divided by 12,000, that is COGS, multiplied by 365, that is 60.8 days. So our DPO given the example is 60.8 days. Similarly, days inventory outstanding, DIO, means on average how many days does it take for a company to hold its inventory before it can be sold. It is calculated as days inventory outstanding, inventory, that is 3,000 rupees, divided by COGS, that is 12,000 rupees, multiplied by 365. So that is 91.2 days. So our DIO is 91.2 days. So cash conversion cycle for a company is the time it takes the company to convert its inventory into sales plus the time it takes the company to convert sales into actual cash inflow minus the credit period it receives from the supplier. So in this case, our cash conversion cycle is days inventory outstanding plus days sales outstanding minus days payable outstanding, which is 81.1 plus 91.2 minus 60.8, that is 111.5 days. Now to forecast accounts receivable, accounts payable and inventory, we use DSO, DPO and DIO, and once we have AR, AP and inventory forecast with us, we can simply calculate working capital for that year as accounts receivable plus inventory minus accounts payable. And by comparing a particular year's working capital with that of the previous year, we can calculate the change in working capital, which can then be used to arrive at free cash flow. Now let's say that for our coffee shop, the sales is expected to grow at 10% for next year. What would be the forecast of various working capital items? Sales next year 18,000 multiplied by 1 plus 10%, that is 19,800. COGS divided by sales of current year is 12,000 divided by 18,000, that is 16.67%. So COGS for next year basis 19,800 sales multiplied by 66.67 is 13,200. We know that our DSO is 81.1. So our AR for next year divided by the sales multiplied by 365 is 81.1. When we solve for AR for next year, it will be 4,399 rupees. Similarly, DPO is 60.8. We know that next year COGS is 13,200. Basis 365 days, we calculate for AP and that comes to 2,198. We also know that DIO, which we calculated earlier, is 91.2. Given our COGS is 13,200. Our inventory basis 91.2 as DIO is 3,298 rupees for next year. So our current working capital is 4,000 plus 3,000 minus 2,000, that is 5,000. However, next year we see that it's 4,399 plus 3,298 minus 2,198, that is 5,499. So with the increase of 10% sales, we have to invest rupees 499 extra for next year in working capital, which is needed to support the increased sales. In the next video, we will discuss step 2 and step 3 to arrive at DCF valuation. Step 2 is building forecast. The next task in building a DCF model is to project all the items that are included in free cash flow calculation for future years. We start with forecast of EBIT, depreciation, plant, property and equipment, and working capital. Over the short run, which is typically first 5 years, we forecast each financial line item that impacts any of these items, such as sales, COGS, gross margin, selling expenses, accounts receivable, accounts payable, capital expenditure, depreciation, inventory, and so on. To calculate the value of cash flows beyond 5 years, we use continuing value formula to arrive at terminal value, which is described next. Beyond a point, say after 5 years, forecasting the individual key drivers on a year-by-year basis becomes impractical. Instead, we use a perpetuity-based continuing value such that value of operations is equal to present value of free cash flow during explicit forecast period plus present value of continuing value. The formula for continuing value is very straightforward, and let's see how it is arrived at. Imagine you have n years as explicit forecast period for which you have forecasted individual line items, and you wish to know the continuing value of operations after that period without having to forecast individual items, since it is not really practical to forecast items beyond a point. Now let's say that your free cash flow in year N as forecasted is denoted by FCFN. Now say you forecast that this free cash flow would continue to grow at a fixed rate, say G% every year after nth year. So your FCF for year N plus 1 would be FCFN multiplied by 1 plus G. For year 2, that is N plus 2, would be FCFN 1 plus G raised to 2, and so on. And this would continue for perpetuity, that is forever. Now say your cost of capital is denoted by R. So if you were to calculate present value of all these future cash flows to year N, that is continuing value, it would be continuing value as of year N, that is FCFN multiplied by 1 plus G divided by 1 plus R, that is year 1. Year 2 would be FCFN multiplied by 1 plus G raised to 2 divided by 1 plus R raised to 2, and so on. Now since G is usually less than R, the value of 1 plus G divided by 1 plus R would be less than 1, and this becomes a decreasing infinite geometric progression with the first term as FCFN multiplied by 1 plus G divided by 1 plus R, and common ratio or decay rate as 1 plus G divided by 1 plus R. And from high school math, we can recall that the sum of such infinite GP or geometric progression is A divided by 1 minus C, where A and C stand for first term and common ratio respectively, And on substituting the value of A and C in the formula, we get continuing value as of year N as FCFN multiplied by 1 plus G divided by 1 plus R, this whole divided by 1 minus 1 plus G divided by 1 plus R. On solving this, we get FCFN multiplied by 1 plus G divided by R minus G. Please note that this continuing value is present value of free cash flows at year N. To calculate this continuing value's present value as of today, we need to further discount it by N years. That is, continuing value as of today equals continuing value as of year N divided by 1 plus R raised to N. That is FCFN multiplied by 1 plus G divided by R minus G multiplied by 1 plus R raised to N. Simple, wasn't it? As we have learned earlier, to calculate present value of future cash flows, we need a discount rate R, and for DCF valuation, the cost of capital is used as the discount rate. A company with higher cost of capital would have a higher discount factor, resulting in lower valuation, just as we had learned earlier. The reason cost of capital is used as discount factor is because the return on the operation should be higher than the cost of capital, because else one is better off using this capital somewhere else, say deposit in a bank to earn interest, instead of investing it in the business. In that sense, the cost of capital is also referred to as the hurdle rate or the opportunity cost that a project must earn for it to be worthy of the investment. Cost of debt. Previously, when we discussed cost of capital, we took the example of business borrowing entire capital money from bank in the form of a loan or debt, in which case it is easier to understand the cost of capital, which is simply the interest rate one has to pay on that debt. So here the interest rate is the cost of debt, which is also the cost of capital, since the entire capital is in the form of a debt. Cost of equity. But what if the business borrowed some money from the bank and some money was invested by the owner himself or herself in return of the ownership of the company? The money that was borrowed from the bank is referred to as debt, and the money that is invested in the business by the owners, also called promoters and investors in return for the ownership, that is shares of the company, is referred to as equity. For debt part of the capital, we know there is some cost associated in the form of interest rate. But what about the equity part? Is there any cost associated with it, since we do not have to pay any interest on it to the owner or to the investors? You may be surprised, but yes, there is. While it is true that there is no direct cost associated, but there is an opportunity cost associated with this investment. What it means is that had the owner or the investor invested the same money somewhere else, say in a fixed deposit with a bank, they would have gotten certain return, say 6%, and they are foregoing that opportunity by investing in this business. And it would make sense for them to invest in this business only if they believe this business would earn them more returns than a simple fixed deposit. Now, other than opportunity cost, there is one more factor which influences cost of equity. It is the riskiness of the business in which the money is being invested. For a riskier business, you would expect higher return, and hence it would have a higher cost of equity or cost of capital. For example, let's say you have 1,000 rupees to invest. You can deposit it in the bank and earn a guaranteed return 6%, which let's say is the zero risk opportunity cost. Now you can invest the same money in a traditional business, say Hero MotoCorp, where you are more confident that business would do well and you would not lose money. The other possibility is that you invest the same money in an internet business where you know it is a new age business and hence riskier. There is a chance you may lose all your money. If both the businesses promise you 10% return, which is more than 6%, your risk-free opportunity cost, which one would you invest in? Naturally, in traditional business because you know it is safer. You would invest in internet business only if you believe it would offer you much higher return, say 20%. It is the same money, rupees 1000, same risk-free opportunity cost 6%, but the cost of equity for both the businesses is different because the risk profile of both the businesses are different. So the cost of equity depends on the zero's risk opportunity cost, also referred to as risk-free return, as well as the riskiness of the business. If we were to represent this mathematically, there are three components to cost of equity. First is risk-free rate of return. Instead of investing in this business, had the investor invested the money into fixed deposit or government bond, where there is virtually no risk of losing, there would have been certain return to investor would have got which he or she is foregoing by investing in this business. This rate of return is referred to as risk-free rate of return. Usually the yield of a 10-year government bond is taken as a proxy for the risk-free rate. Market-wide risk premium. Instead of investing in this particular company, had the investor invested in a portfolio consisting of all the companies in the market, there would be a certain average return that he or she would expect for taking an average risk. Difference between this average return and the risk-free rate of return is referred to as market-wide risk premium, and it can be calculated as stock market return less risk-free rate. And finally, beta, a risk-adjusted factor that reflects each company's riskiness relative to the average company or the average market. If a company is riskier than the average market, value of beta would be higher than 1, and hence this company's cost of equity would be higher than that of the average market. For example, imagine the risk-free rate of return to be 6%. Imagine the average stock market return is 16%. And then say beta is of the company being evaluated as 1.5. Then cost of equity for this company would be 6% plus 1.5 multiplied by 16% minus 6%. If you solve this, you will get 21%, which is higher than the average stock market return of 16%. Beta can be calculated by regressing share price movement of the company to the broad market index. If these terms look frightening, don't worry. What it simply means that you look at the historical share price of the company and see how that has changed and compare that with the change in overall market index and arrive at its beta. We will calculate beta for Hero MotoCorp when we calculate the cost of equity for Hero MotoCorp. This will become clear to you then. Accordingly, the formula for cost of equity is equal to risk-free rate plus beta multiplied by market return minus risk-free rate. Recession and euphoria in the market can lead to market risk premium being calculated as aggressive or conservative. So based on the research by Goldman Sachs and McKinsey, market risk premium is usually between 4.5 to 5.5 on an average for a long period of time. You can assume a 5% MRP for the calculations. Weighted average cost of capital. Now for a business which has both debt and equity in its capital structure, we simply take the average of cost of debt and cost of equity, weighted by their respective share in total capital, to arrive at weighted average cost of capital, or WACC, which is defined as WACC is equal to debt divided by total capital multiplied by cost of debt, 1 minus marginal tax plus equity divided by total capital, that is debt plus equity multiplied by cost of equity. D stands for debt, E stands for equity. D plus E will be total capital. KD and KE represents cost of debt and cost of equity respectively. TM stands for marginal tax. Let's look into why do we need marginal tax in case of debt and not in case of equity. This is also called tax shield for cost of debt. You will notice that how the cost of debt has been reduced by the factor of 1 minus marginal tax rate. This is because the interest we pay for debt is an expense which gets deducted before taxes are paid. And this results in a business having to pay lesser tax, which saves money for the business. Due to this, the real cost of debt for a business is less than what it actually pays to the lender. And this factor 1 minus TM reflects that. For example, if you took rupees 1000 loan on which you have to pay 10% interest, that is rupees 100. Now say your EBIT is 300 and tax rate is 30%, which means you have to pay rupees 90, that is 300 multiplied by 30% as taxes. But since rupees 100 is the interest cost or interest expense, that first needs to be deducted from EBIT. So your profit before tax would become 300 minus 100, that is rupees 200. And your tax expense would be 60, that is 200 multiplied by 30%. That means you had to pay rupees 30 less than what you would have to pay had your entire capital was financed by equity. So real cost of debt is not rupees 100 but rupees 70, that is 100 minus 30, that is tax saved. Hence your effective cost of capital is 10% multiplied by 1 minus 30%, the TM, the marginal tax rate, which is 7%. That is rupees 70 as we saw in this example. Cost of equity and weighted average cost of capital are extremely important concepts, and make sure you understand those thoroughly before you proceed further. If need be, go over the videos a couple of more times. We would demonstrate how WACC is calculated for Hero MotoCorp when we do its valuation later in this module. In this video, we'll be covering step 5, 6 and 7 of DCF valuation. So step 5 is calculate DCF value. So once we have WACC, that is weighted average cost of capital, we use it to discount the future cash flows to arrive at the value of the company. So that is the DCF value. 6 is performing sensitivity analysis. Throughout DCF valuation, we make several assumptions. These assumptions can be about the forecast we have made of various line items or that of growth factor to arrive at continuing value, etc. The final number we arrive at for a company's value can be quite sensitive to these assumptions, meaning a slight change in those assumptions can vastly change the valuation number. Hence, it is important to perform a sensitivity analysis for all those assumptions by imagining different scenarios and see how the valuation number changes as you change that particular assumption. For example, you can make an optimistic, average or a pessimistic assumption of terminal growth rate or revenue growth and see what valuation you arrive at for each of the scenarios. This will make your analysis and valuation more robust and you would be able to make better decisions. We will demonstrate how to perform sensitivity analysis when we do valuation of Hero MotoCorp in the next topic. Step 7 is adjustments to DCF value to arrive at equity value. So DCF gives us the enterprise value of future operations. We need to add current cash and other non-operating assets to it and subtract debt from the DCF value to arrive at the equity value of the company, which when divided by total number of shares of the company gives us per share value of the company that we can compare with the market share price. So equity value is equal to DCF value plus cash plus other non-operating assets minus debt. And per share price will be equity value divided by total number of shares. So with that, we have covered all the 7 steps in more detail. Now in the next topic, we will be going step by step for Hero MotoCorp. Stay tuned. Now we apply our learning of DCF on a real company, Hero MotoCorp. Together, we will go through the various steps necessary for the preparation of a DCF model and learn what stays behind this valuation technique. We believe that the model which we will introduce is a good representation of what is often used by practitioners. Let's start our valuation exercise. We saw these 7 steps earlier to arrive at DCF valuation of a company. We first reorganize the financial statements. We build forecast. We estimate continuing value. We calculate weighted average cost of capital. Then we calculate the DCF value. We perform sensitivity analysis, and then we adjust the DCF value to arrive at equity value. We will follow all these steps for Hero MotoCorp. Stay tuned. The first step in DCF valuation is reorganizing the company's financial statements. As you can see that we performed most of the reorganization, that is segregating operating and non-operating items, in our previous module. Given that the company has recently published 2018-19 report as well, we have updated that in the Excel with last year's information, that is data for 2018-2019 for both profit and loss as well as balance sheet. The link to the Hero MotoCorp 2018-19 annual report is given in the helper text below that you can use to reorganize the financial statements for that year. You may notice that we have also added the reorganized financial statement for year 2013-14, 14-15 and 15-16 to this sheet, as we would need them for DCF valuation. The process remains the same, and the links to the annual report of these years is also given in the helper text below. In the next video on forecasting, we'll first walk you through our entire DCF model, and then we will start building the forecast. In the previous video, we showed you the reorganized financial statements that we developed in module 4. In this video, we'll start with building forecast. Let's go through the initial structure of our overall model. Well, the sheet has 3 parts: input, output, and sources. All the sheets are empty except the sources of financial data that has the reorganized data of Hero MotoCorp. Under input sheet, we have P&L assumption sheet. This is a sheet in which we will build our hypothesis regarding various P&L items. Here we will calculate historical ratios for the items and model their future development. We will build 3 scenarios for each item: optimistic case, base case, and pessimistic case. And as you can see, our explicit forecast period will be 5 years from 2020 to 2024. Balance sheet assumption sheet will include our hypothesis regarding the development of various balance sheet items. It is a good practice to have clean output sheet which are linked to the sheets that include various assumptions and calculations. So P&L and balance sheet input sheet will be linked with P&L balance sheet output sheet. We will show this as we progress with building our DCF model. Cash flow and DCF valuation sheet will include cash flow assessment and discounting of those cash flows to arrive at company value. And the last are the sources. We have already mentioned we have this data with us, that is reorganized financial statements for Hero MotoCorp, both P&L and balance sheet. So this goes in the source files. Excel file has been provided to you in helper text below so that you can also build the DCF model along with us. This is the structure of our valuation file. Thank you for watching. We will be creating DCF model for Hero MotoCorp. In this video, we will see how to model the revenue of Hero MotoCorp. The first thing we will create is this button called selected case, and we'll color it in, say, dark blue for now. We'll just take the number 1 inside of it. Let's write down which will be the 3 scenarios starting in H2. We suggest having the following cases: optimistic case, base case, and worst case. The optimistic case will include better than historical growth of revenue. The base case will include the historical growth of revenue, and the worst case will include only a marginal growth of revenue when modeling the future development of company's revenue. So let's start with the revenue. We will type it in B8. We will link to the figures which we have as mentioned in the source file. So under P&L source file, you will find information on revenue. You will just link this cell to the one in the source file. Then we will calculate the revenue growth for historical period by using a formula. So let's say for 2016 revenue, you divide it by 2015 revenue minus 1. So that will give you the growth rate for 2016. We can see that our revenue grew by around 5%. We will have case 1, case 2, and case 3. We will not build scenarios for the historical period, and we can indicate that by formatting those cells. We can probably use a color pattern to indicate that nothing goes in those cells. Let's introduce some values corresponding to the 3 scenarios. Case 1 is the optimistic case. Hence, we will assume that the firm will grow more rapidly. Let's say that the company will grow at 7% annually. We'll apply this for all the other years for the forecast up till 2024. It is reasonable to model the base case as the average historical performance of the firm, that is 5%, and for the worst case, we can assume 3% growth for the next 5 years. Next, we will learn how to use the choose function in order to render our model flexible and allow it to work across all 3 scenarios. We'll select the cells above the 3 cases and type choose, the first argument which needs to be selected. That is the index number. This is the button which will determine what case will be selected. Given that this will be the only button which will select scenarios, we will fix the cell reference. The other argument of the formula are the growth percentages of revenue in the 3 scenarios. Once we select all the 3 of them, the formula will be complete. Currently the function is showing 7% because scenario 1 is selected. If we change to scenario 2, we see that the year-on-year growth becomes 5%, and when we change to 3, it changes to 3%, which is for the worst case. Let's copy the formula for the rest of the years. Now what we need to do is calculate revenue for the forecasted period. This is easy because we already have old revenue number of financial year 2019. You need to grow that number by the growth rate and you will get the number for year 2020. If we change the selected case, revenue figures change as well. We can drag this formula across all forecasted periods. So here you see that we have been able to create forecasted numbers of revenue. In the next video, we'll cover rest of the P&L items. Thank you for watching. We will continue developing assumptions on the P&L. In the previous video, we created assumptions about the revenue. We will move to the rest of the items on the P&L. So let's link it with the P&L source file. The next item is cost of material consumed, also called cost of goods sold. So we'll just link it with the source file here, 2014 data onwards, and we will copy it for the rest of the years. In this, we will base most of the P&L items as percentage of revenue. The logic around that is, as your revenue increases, your cost increases. So this is the percent of sales. We have been using choose function, so we can simply copy choose function, because again we have to create scenarios. Scenario 1 is optimistic, scenario 2 is the base, and scenario 3 is worse than the historical average. We know here that 69%, which is actually the last year, has been the worst performance. So we can assume 69% here. We can assume the historical average to be case 2, which is 66%. Our case 1, which is optimistic, is 62%. As we can see that scenario 3 is selected, so by default it's picking up 69%. So let's ensure that all these items are positive. So the percentage of sales, I've just added negative minus sign in front of that. So the 69% is basically cost of material divided by sales. So we are saying in 2020 it will be 69%, selected case 3. So that basically becomes as 69% of 34,991. And we can drag it for rest of the years. So as you can see, when we change, these numbers change. So with this, we have completed cost of materials consumed. Similarly, we will move to the rest of the items in P&L that we need to model. Although we are modeling excise duty because in historical years it used to be there, but remember that after the implementation of GST, this excise duty is not there anymore, which is indicative here also. As you can see, it used to be there historically, but it is coming down to almost zero. In July 2017, GST was implemented. Again, this needs to be percentage of sales. So it will be actually zero, but as a matter of completion, we will create the scenarios. But in all the scenarios, it will be zero. And we can use similar choose function here. And since we are assuming 0%, so obviously the value will be 0 here. It's not a percentage number, it's absolute. So here it is. Although we have modeled, but it will not have any impact. So now I am looking into the employee benefits. Employee benefits, we need to link it here. So employee benefits, we see that they are average around 4%, with maximum being 5% and minimum being 3%. The next item are other operating expenses. Again, we link it to the source file. Since we are copying the formula, so the cell reference is changing. So that is why it's important to see why the reference is changing and what should be the right reference. As we can see that it's more or less around 11%, the average, with maximum also being around 11% and minimum around 9%. This we again have to link it with the sales. So as of now, we are just creating these assumptions. Once I just saw with employee benefit, it's the reference needs to be sales, so I'm just changing that. This remains 0. It is always good to check whether the references are working fine or not. As you can understand that we need to achieve EBIT level information, which will include depreciation as well. So let's model depreciation, and that would be our last item. We can see the average is 2%, the lowest is 1%, and maximum we are seeing is 4%. This is around depreciation, and the last item that we will consider is the tax element. So we are not modeling the tax, it is what it is, and it will be the marginal tax rate. So in India it's been around 35%. There is debate that we might see corporate tax reduction to 30%. So let me just write down the marginal tax numbers here. If you do a quick search on Google to find out what is the historical marginal tax rate for corporates in India, there will be a couple of results. If you click on the first one here on trading economics, you will find all these numbers that you can use. So from here only we have taken up these numbers and used in our model. So this we can assume as 35, this also 35. Again, we can use choose function here depending upon the scenario. So scenario 1 is selected, so accordingly 30% is selected. So with this we have completed P&L based assumptions. In the next video we will create balance sheet related assumptions. Thank you for watching. In the previous video we created all the assumptions related to P&L. Now we move to balance sheet assumptions. Since we have data for 2014 as well, so I'm just adding one of the additional years. So the items that we will be focused on here are not all the items in balance sheet, but rather working capital and plant, property and equipment. These are the two categories where investments happen in case company were to increase their sales. So let's look at working capital first, and one by one we will look into all the components. So the first one is accounts receivable, and if you remember we used days approach, that is days sales outstanding, days inventory outstanding and days payable outstanding. We'll be using exactly that approach here. So let's demonstrate how. We are starting with accounts receivable, also called trade receivable. So here we will calculate DSO. Then we have accounts payable, TPO, inventory, which is DIO. So let's first link all these from our source file, that is balance sheet. So the payable will be in the liability section, current liabilities, trade payables. Inventory would be in the current assets. Now we calculate days sales outstanding, that is accounts receivable divided by net sales multiplied by 365. This is what we learned earlier. We copy it across all the years. These are historical years. And then we do similar exercise for accounts payable. but this is cost of material divided by cost of material multiplied by 365. So it's accounts payable divided by cost of material, also called COGS, cost of goods sold, multiplied by 365. Since days can't be in negative, so we put a negative sign in front of that. And now we have DIO, which is inventory divided by, again, cost of material multiplied by 365. We put negative sign in the front and we get DIO. If you remember cash conversion cycle, CCC as DSO plus DIO minus DPO. So what does this mean? This basically means that this company rarely needs money in terms of working capital management. However, looking at the historical records, the requirement is declining drastically. So moving as high as 30 to within 2 years, going down to 4.6 as cash conversion cycle is an indication of bad health. It's not a great health. Had it been the other way around, it is considered to be good. However, given that this company has a negative working capital, this indicates that probably distributors are paying them in advance before that money gets invested in inventory. A motorcycle is manufactured and then sent back to the distributor. So their working capital is negative. However, it is deteriorating if you see last couple of years. So usually cash conversion cycle does not change in a very fast manner. It takes few years for any change to happen. That is why it may be prudent to assume whatever are the last year numbers, they will continue going forward. Unless you have some special information that management has declared that they are moving in a certain direction. In their case, there is no such information that management has shared. Now, in terms of the forecast, we know that 29.5 is DSO. Since we already know the sales number of 2020, we can calculate what would be the accounts receivable for the forecast period 2020. So that will be multiplied by sales divided by 365. And we can copy the formula. Similarly, we have DPO multiplied by cost of sales divided by 365. We will put negative sign. The same way we will have DIO multiplied by cost of sales divided by 365. When we use these assumptions to calculate output in the balance sheet, we will calculate working capital. Cash conversion cycle is DSO plus DIO minus DPO. So that has not really changed because that's our assumption. So this is the assumption sheet for working capital. In the next video, we will create assumptions for the next important item on the balance sheet side, that is plant, property and equipment. Thank you for watching. So in this video, we'll model plant, property and equipment. If you see balance sheet under non-current assets, there are these items that needs modeling. Remember that capital work in progress is part of plant, property and equipment. In case of Hero, these intangible assets are also kind of part of plant, property and equipment because these are computers software that internally they are developing. So what we will do is we will include all these as part of plant, property and equipment. I mean, anyways, we see that the substantial portion comes from these two items only. And now we calculate as percentage of sales, what these numbers are. We already have sales number. So we see that over the last 5 years, the average has been around 15% with maximum 17% and lowest being 13%. So let's take it as average 15% and copy that for rest of the years. Now we know that we have sales number. We can simply multiply our assumption with that of sales for 2020 and we will arrive at the number for 2020 plant, property and equipment. With this, we complete our assumption sheet for balance sheet items. In the next video, we'll start building our P&L account. In the previous videos, we have completed P&L and balance sheet assumptions. In this video, we will complete P&L account and calculate net operating profit after taxes. So we have sales number here. We have to just pick it up from the assumption sheet. Then we have cost of material or cost of goods sold. These are the historical numbers and we also forecasted them. The difference between revenue and cost of sales or cost of goods sold is gross margin. Although our excise duty is replaced with GST, so this number is 0. But in the past, we had these numbers. The next item is employee benefit expenses. And then we have other operating expenses. When you deduct excise duty, employee benefit expense and other operating expense, what you get is EBITDA. That is earning before interest, taxes, depreciation and amortization. Then we have depreciation and amortization. When we deduct depreciation and amortization from EBITDA, we get EBIT, that stands for earning before interest and taxes. Then we have tax rates here. We just link it to our file. And basis this, we calculate EBIT multiplied by the tax rate. This is the tax company has to pay. And when you deduct taxes from EBIT, you get net operating profit after taxes. In the next video, we will create output sheet related to CAPEX, that is capital expenditure, and working capital. Thank you for watching. In the previous video, we completed P&L items and we calculated net operating profit after taxes. In this video, we will calculate capital expenditure or CAPEX requirement, and also what is the investment required in working capital. So let's get started. So first of all, we are given ending values here. We calculated under balance sheet assumption. So this is end of the period values. And we also forecasted these values from 2020 to 24 under balance sheet assumptions. Please note that ending value of plant, property and equipment is also the beginning value of the next year. For example, this 2014 ending value is basically the beginning value of 2015. Now we already have depreciation and amortization that you will find in the P&L assumption. Capital expenditure is basically a plug figure which is calculated basis the ending value of plant, property and equipment, beginning value and the depreciation. Since we do not have the beginning value of 2014, CAPEX calculation can only start from 2015 onwards. We do not have the beginning value of 2014. So CAPEX is and if you total up these numbers, they will match with the ending value of plant, property and equipment. So we just copy the formula. So this is the capital expenditure number that gets deducted from gross cash flow in order to calculate free cash flow. Moving to the working capital items, we have accounts receivable, we have inventory, again under balance sheet assumption, and we have accounts payable. We calculate working capital, which is accounts receivable plus inventory minus accounts payable. Changes in working capital is basically the difference of these two. That is the difference between 2015 minus 2014. So this is the additional money that needs to be invested in the business in order to support growing sales. So far we have covered forecasting of financial statements, that is P&L and balance sheet. In next video we would use these forecasts to calculate free cash flow for future. Stay tuned. So in the previous videos we have forecasted P&L and balance sheet items. We also calculated NOPAT, which is net operating profit after taxes. So in this we will calculate the net cash flow, also called free cash flow. So the first item is NOPAT that we calculated in P&L. Please note that in our balance sheet, our capex and change in working capital is starting from 2015 onwards. That's why this sheet starts from 2015 onwards, since we do not have beginning value of plant, property and equipment basis our model, and also the change in working capital is the difference, so that starts from 2015 onwards. We add non-cash charge to net operating profit after taxes, since company is not paying this as cash but rather it's an accounting entry. So when we add these two items, that is net operating profit after taxes plus depreciation, we get gross cash flow. We deduct any investments that we make in the form of capex and working capital. So we link it with the balance sheet side. And when we deduct these two items, that is capex and investment in working capital, from gross cash flow, we get net cash flow. This net cash flow is also called free cash flow, and this is the cash flow that we use for discounting. In the next video, we will understand how to calculate discount rate in the form of weighted average cost of capital. Thank you for watching. In order to discount cash flows, we need a discount rate. In case of a company, it's cost of capital. We will demonstrate how to calculate cost of capital for Hero MotoCorp in this video. There are two components to cost of capital. One is cost of debt and the other is cost of equity. We will start with calculating cost of equity first. As you know that cost of equity is risk-free rate plus beta multiplied by market return minus risk-free rate. Market return minus risk-free rate is also called market risk premium. This is through capital asset pricing model that helps in calculating cost of equity. So we'll go component by component. The first is the risk-free rate. We have learned earlier that risk-free rate is the 10-year government bond yield. Let's understand from where can we get 10-year bond yield. If you just type in 10-year government bond yield in Google, it will show you a couple of results. You go on Bloomberg.com, India government generic bid, you see that 10-year government bond yield is shown as 6.48%. This is the close price as of today. This changes every day. So whenever you are calculating your capital asset pricing model, this is the 10-year government bond yield you have to use. Please note that the range of a 10-year government bond yield does not vary a whole lot. So if you are seeing this as 6.5% approximately, it will not be very different tomorrow. It might rise up by 0.01 or 0.02 or it might decline, but it will be in this range only. So every day you don't have to update this number. So we can put here 6.5% for risk-free rate. The next component is equity beta. And we know that how do we calculate equity beta? We need 60 monthly data points to regress it against a broad market index. So here we have Hero MotoCorp share price and we need it for 5 years. You can type in Hero MotoCorp under Yahoo Finance. In that you can go on historical data. In this you can select 5 years and monthly and apply. When you download this data, you can download in Excel format and use that data for your analysis. So I've downloaded this data and that we can use. Similarly, you can use for the broad index under Yahoo Finance only, that is NSE 500. You can either go to NSE India website and download that index data, or that data will be available under Yahoo Finance. You can download it from there. There are various share price values as opening, closing, high, low, etc. What you need to do is take up adjusted close price. That is the price you need to consider. So here we have data for both Hero MotoCorp and NSE 500. Now we need to calculate monthly return. F4 divided by F3 minus 1. This is the monthly return. We copy the formula and we do that for all the months. So we have these as 60 data points. Now we need to regress this data over this data, and that is the beta value. And how do we do that? This is a formula in Excel that is equal to slope. So the y-axis should have Hero MotoCorp data in this formula, and x-axis should have the index, that is NSE 500 data. bracket starts, you select one axis and you select the other axis, we get equity beta. So beta can be more than 1, less than 1. Less than 1 means it is less volatile in comparison with the market. More than 1 means it is more volatile than the market. So in case of Hero MotoCorp, we see that it is 0.47. That is, if the market movement is 1%, Hero MotoCorp share price has moved by 0.47%. Beta can also be equal to 0 or can even be negative. So what does a beta equal to 0 mean? Basically means that whatever is the movement of market, the share price movement of the company is not associated with the market. So it does not move. And in case it is negative beta, it basically means that the share price movement of the company is actually opposite of that of the market. If market has moved by, let's say, 1% and let's say the company's beta is -1, so the share price movement is -1% where market return is 1%. Usually you will find beta around 1. It could vary from say 0.3, 0.4 to 1.5, 1.6. Usually companies will be in this bracket. Now we talk about market risk premium, which is market return minus risk-free rate. As we discussed earlier, that in times of any pessimism or euphoria in the market, a particular period calculation of market risk premium, that is market return minus risk-free rate, may not be indicative of the true market risk premium. Therefore, there are researches done by Goldman Sachs and McKinsey, and they have done it for the US market over the last 100 years, that indicates a market risk premium of 5%, which basically means that if market risk, if the risk-free rate is 6.5% in our case, market overall, from an equity investor expects 11%, 11.5%. That is 6.5 plus 5%, 11.5% is what market expects, an equity investor would expect. There are times when this market risk premium may indicate 2% if you do the calculation, or it may indicate 7-8%, but on an average 5% is established as a market risk premium over a long period of time. The range is between 4.5 to 5%. We are taking 5%. So let's apply capital asset pricing model here, where risk-free rate is 6.5%, equity beta is 0.47, and market risk premium is 5%. When we solve this equation, we get 8.9%, which is basically what equity holders expect when they are investing in Hero MotoCorp. So now we move to the next component of cost of capital, that is cost of debt. Just like individuals have CIBIL score, the same way corporates have their own credit worthiness. In case of Hero MotoCorp, this is a debt-free company with positive cash flows. They can have a better negotiation with the bank in terms of the cost at which they can borrow, which would hardly be 1% more than, say, a risk-free rate. Risk-free rate is the borrowing rate by Government of India. So any rate has to be higher than a risk-free rate. So in case of Hero, that rate would be around 7.5%. However, when we talk about companies that are filled with lot of borrowing already with very weak cash flow, say real estate companies, they will even struggle to get a loan at 18% because there is a risk of default and no bank wants to or lend them money because there is a probability of default. In case of Hero, the probability is not there of any default. The reason is it's a cash rich company, and you can also see from the cash flows it's generating. So it's 4,000 crores per year kind of cash flow with hardly any debt. Any bank would be more than happy to lend them money. It can be assumed that they are borrowing at one of the lowest rate, say 7.5 to 8%. So let's assume 8%. Although it's a zero debt company, so our cost of capital will not be impacted by this. It would be somewhere between 7.5 to 8%. So we are assuming 8%. If you remember our scenario 2 and 3, which is base case and worst case, we assumed that tax rate remains 35%. And in case 1, which is optimistic, we assume that tax rate is going down to 30%. So depending upon the scenario, this selection should be made. If you're looking at optimistic, it should have 30%. Otherwise, it should use 35%. Ideally, link this to the tax rate of 2020. So accordingly, whichever case you select, this number would vary. Either it would be 30% or it would be 35%. So our cost of debt is 5.2%. Now we need to apply the weights of capital, that is what component is equity and what component is debt. We understand that most of it is equity and very less is debt. How much is debt? Let's look into that. We should use market value of debt and market value of equity. However, in most of the cases, debt market value is not available. Equity market value is available for public companies. The logic is that if you were to raise capital, it will depend upon the current market price and not on the book value. Therefore, this equity and debt split should be based on market value and not book value. In our case, we will be using market value of equity for Hero MotoCorp and book value of debt for Hero MotoCorp, since it's not a listed debt. So we have to rely on the book value. So if you link it with our source file of balance sheet, there would be short-term debt and there is a long-term debt. So we see here that around 309 crores is the component of debt. What is the equity value? When you look into the annual report, we see that 19.97 crore are the outstanding shares. What is the current share price? You Google it and you find it that the current share price, obviously the share price changes every day. As of today, that is 26th of August, the price is around 25.90. Market cap is basically 19.97 multiplied by 25.90. So you can see that more than 50,000 crore is the equity component and debt component is hardly 309 crores. So most of it, as you can find out here, which is equity divided by total capital is the sum of these two, is 99.4%. So it is basically driven by equity, the entire cost of capital. Debt component is hardly 0.6. 0.6 multiplied by 5.2% will be a very small number, although it will have some cost here, but it will be very less in the capital structure since it's mostly equity. And 99.4% multiplied by 8.9% is 8.808. When we add them both, we get 8.8%, which is actually very close to cost of equity. So in this video, we tried to arrive at discount rate. So couple of components that we used: risk-free rate, that is 10-year government bond yield; equity beta, we regressed share price, monthly movement of share price of the company with that of the broad index; The slope of that is equity beta. We use 5% market risk premium. We use KPIM, that is 6.5% plus 0.47 multiplied by 5%, which gives us 8.9%. Cost of debt, since it's a debt-free company generating high level of cash flows, we assumed one of the lowest categories, that is 8% cost of debt. Marginal tax rate 35% to arrive at cost of debt. We apply the capital structure, which is market cap for equity and debt for the book value of debt. In their case, it's mostly equity. We apply these weights to the cost and we arrive at the weighted cost of equity and weighted cost of debt. We add them both to arrive at weighted average cost of capital, also called WACC. So this is the discount rate that will be used to discount our cash flows. Thank you for watching. So in the previous video, we calculated discount rate. Now we use that discount rate to discount net cash flow. So we link weighted average cost of capital here where we calculated. Along with that, we also use terminal growth rate. So these are the assumptions that go in, especially for longer term. So discount rate will be used across all time period, but terminal growth will be, as the name suggests, applied to calculate terminal value or continuing value. So we already have net cash flow in our cash flow sheet. We need to have a discount factor. Discount factor will be calculated from weighted average cost of capital. In this case, that's the discount rate. So discount factor is equal to 1 divided by 1 plus WACC. We can apply $sign here because this remains static. For the first year, that is 1 year from now, 2020, we are discounting it by 1. The next year it will be 2, then 3, 4, and 5. Discount factor will be used to calculate present value of future cash flows. So when we multiply net cash flow with discount rate, we get present value. We call this as DCF value, so which is basically the sum of discounted future cash flows The next that we do here is calculate continuing value, or also called terminal value. This is the formula we are already aware of to calculate terminal value. So let's apply that. So continuing value would be 2024 net cash flow multiplied by 1 plus the growth rate divided by WACC minus G, which is 8.8 minus 2%. We need to calculate present value of, we call it continuing value CV here, which is the value we got multiplied by the discount factor. So our enterprise value, which is the company value, is total of DCF value plus the present value of continuing value. We need to understand how much is being contributed in the next 5 years. So the value is around 26%, and the rest comes from terminal value, which is 74%. And at this stage, we should also check that we created different scenarios: optimistic, base case, and worst case. Let's see if you change those scenarios. Right now it's base, so let's change it to one which is optimistic and see the impact on the enterprise value. It becomes more than 1 lakh crore. In second scenario, the value is 58,000 crores, and in third scenario it is 34,956 crores. So this gives you a range of the enterprise value. That range is around 35,000 to around 1,01,000 crores. We'll use the base case scenario to assess what market expects this company to perform. In the next video, we'll show you exactly that. Stay tuned. In the previous video, we saw that our enterprise value is 58,308 crores, and we figured out that 74% of that is being contributed by terminal value, is the present value of continuing value, which is 74%. We also understand while calculating WACC that this enterprise value that market is saying is a combination of equity and debt, which is basically adding these two numbers. So around 52,000 crores is what market is saying is the value of this company, and what you are arriving at using DCF valuation method is 58,308. So we are trying to establish more sensitivities around what should be the growth rate. One way of looking at it is understanding what market expects from this company in terms of the growth. The expectation that the scope of market growth is not great and there is enough competition by electric vehicles, and that might take away the market share. So what exactly is market assuming this terminal growth rate in its assumption? That you can do by applying goal-seek function. So go on data tab, go on what if, goal-seek. You need to set this number equivalent to 52,000 by changing terminal growth cell. As you can see that market is assuming around 1% kind of growth rate. So it is your industry understanding that can give you a view that you may assume that it is 0% or it is plus 5% or 10%, but that is your deep understanding of the industry and also the company. We also understand that a terminal value, by the virtue of the formula that you use, is impacted by these two elements, that is WACC and terminal growth have a huge impact on terminal value, and this has an impact on enterprise value. In order to understand what is the impact, how sensitive these values are to the value of a company, we perform sensitivity analysis. So let's take sensitivity of growth from let's see sensitivity of growth from 0 to 4%. Although market is assuming 1%, we used 2%. We also link this cell to the enterprise value. And here we have the WACC number. When you select this entire chart, the entire area, go on Data tab, go on What If, and insert Data Table. Select the row as the growth and column as WACC, because that's the selection you've made here, and you select OK. So this is the sensitivity of numbers. For example, at 1% and 8.8%, around 52,000 crore is the value. If it were 0.9, this number would match. We assume 2%, so around 58,643 is the goal there. So around 58,643 is the value there. So this really indicates how sensitive your numbers are to the assumption of WACC and growth. DCF valuation is very sensitive to your assumptions that you use, especially for terminal growth and WACC. That is why running a sensitivity analysis can help you understand how sensitive is the value basis the assumptions that you're using. In the next video, we will adjust the enterprise value number to arrive at the equity number. Thank you for watching. In this video, we arrive at equity value. So what we need to do is we need to deduct debt and we need to add non-operating assets. So you will find debt information under balance sheet source, that is short-term debt and long-term debt. And we need to add non-operating assets. and also on the non-operating asset on the current asset side. We also need to add cash. We need to find out what are the shares outstanding. That information you'll find under annual report. So if you go on page number 200 of annual report 2018-19, under equity share capital, you will find this information of number of shares outstanding in calculating per share value. We have to just convert these into crores because our equity value is also in crore. So per share value is equity value divided by share outstanding. So with this, we completed our DCF valuation for Hero MotoCorp. As you can remember that our valuation depends a lot on our assumptions, and our assumptions would depend upon our knowledge about the industry, the company, and where we see the company and the industry going forward. So whatever assumptions that you use, it is important that you understand the reasonableness of those assumptions. In the next video, we will understand another way of doing valuation, which is through relative value. Thank you for watching. As we mentioned in the first topic, in relative valuation, we determine a company's value by comparing it to similar companies' value. A careful multiple analysis can be useful in making DCF valuations they generate more accurate. One of the most popular ratios to do this is price to earning, also called PE ratio, which is the ratio for valuing a company that measures its current share price relative to per share earnings. The letter P in the ratio refers to the current share price at which particular company's stock is trading in the market at the moment. You can find this online on the stock market website. The letter E in this ratio refers to per share earning that can be arrived at by dividing profit after tax, that is the number available in the company's latest financial statement, with that of total number of shares issued by the company. P/E ratio are used by investors and analysts to determine the relative value of a company's shares in an apples to apples comparison. What we do in this is that we calculate the P/E ratio of the company under consideration and compare it with the P/E ratio of the company in similar industry or with P/E ratio of the entire industry as a whole. If a company's P/E ratio is higher than that of the competitors or industry average, it means that market is paying a premium for this company's shares vis-a-vis that of other players in the same industry. This could be because either the market is bullish about this company's future performance, or could just be that the market is wrongly overvaluing this company purely based on sentiments when there is no fundamental reason to do so. Similarly, if a company's PE ratio is lower than that of the industry average, it means the market is less excited about the company's future prospects than that of its competitors. Whatever story the PE ratio tells you, it is important to understand if there is any fundamental reason as to why the market is behaving the way it is and arrive at your own conclusion accordingly. P/E ratio can be used to compare a company against its own historical record or to compare aggregate market against one another or over time. So now let's calculate P/E ratio of Hero MotoCorp and compare with its peers. Remember that lower the P/E ratio indicates undervalued, whereas higher P/E indicates overvalued. In this video, we will calculate P/E ratio for Hero and we'll compare it with the competitors. And we will also see historically where the price to earning ratio was with respect to Hero MotoCorp. So let's get started. We see that there are three more competitors of Hero, that is Eicher Motors, TVS Motor and Bajaj Auto. You can always find this information on the earnings side in the annual report, but that data is also available on different websites. So one of the most popular website for Indian equities is something called screener.in. So screener.in, when you go, you will see something like this. In this, when you type in company's name, it will show up the information, and lot of information can easily be found on this website. This is not a substitute of annual report, but something like P/E ratio, which is quite fast to calculate. You can source the information from this website. So we can see that the current price is 25.91. EPS, which you will find under profit and loss account. Within that, I see the latest EPS, which is March 2019 to be 172.4. P/E ratio is price divided by EPS, earning per share. So it is 15 for Hero MotoCorp. Let's see in terms of competitors where Hero MotoCorp is. So the first competitor is Eicher Motors. Again, we have the current price and we have the EPS. Please note that you can find this information even in the annual report of, say, Eicher Motors. So we see that for Eicher Motors, the P/E ratio is 19.3. By just comparing 15 and 19.3, looks like Hero is undervalued in comparison with Eicher Motors. We'll continue for TVS Motors now. So in comparison with TVS, again, Hero is undervalued. Last company is Bajaj Auto. Is fairly close to Bajaj Auto, but if we compare all the companies stacked against Hero MotoCorp, we see that Hero is actually one of the cheapest companies available basis just the price to earning. Now we see historically where Hero is in comparison with the historical data of price to earning of Hero MotoCorp. As you can see that we have the EPS number here, so we can just note it down. With respect to the price, you can either go on NSE website to really find out historical price, or these websites can also help you with these numbers. So we have the EPS number. 29th of March, the price was 2553.15. Similarly for (2018) it was 3496.4, and accordingly you will find all the information for rest of the years the same way. You can select the period here, or you can go on different websites. Even NSE India would have the information. You can go on NSE, you can go on BSE to find out this information. Now we calculate the PE ratio historically. As we can see that historical PE ratio of Hero MotoCorp has been dropping, which basically indicates that market is continuously turning more cautious about Hero MotoCorp future growth. So if we combine DCF valuation as well as PE ratio, we feel that Hero price right now is fairly priced. So that brings to the end of our last session on price to earning. Our long journey of financial modeling and valuation comes to an end. We hope that you are able to learn a lot of new concepts and see their application, that our analysis are based on our deep knowledge of the industry and company. We hope you will continue to deepen your knowledge and make your analysis as effective as possible. Once again, thank you, and we hope you become best financial analyst.